Hi folks, and welcome to the Financial Argument channel. Today's episode is the looming housing market crash. Everything will end with a bang. Please take a look at the chart carefully. It's possible to say that the biggest threat facing the Fed is the collapse of the housing price bubble, which could even be a bigger threat than the stock market bubble. This chart alone is an indicator that we're facing a 2008-like housing crisis, perhaps even worse. I'll explain it to you in more detail. Please watch the video to the end. Let's begin. The total value of the U.S. real estate market, which is on the edge of a collapse that I'll be talking about in this video, is worth approximately $34 trillion. That's almost as much as the 13.6 trillion Chinese GDP and the 20.5 trillion US GDP combined. Anyway, if you ask a real estate agent whether or not there is a real estate market crisis on the horizon, their answer will definitely be no, just like always. This is the same answer you would have received if you'd asked the same agent the same question right before the 2008 financial crisis. I don't know if you've ever had a friend in the real estate business who is extremely familiar with the realities of the real estate market, but I never have. While I've known a lot of people in real estate, they never seem to understand the market realities. They're always too optimistic, just like car salesmen. And just like car salesmen, most people in real estate make money on commission, so they never want to believe unfavorable predictions or foresee the collapse of the housing market sector. They want to convince people to get them to buy their product because otherwise they'd make far less money. Well, the reality doesn't match their optimistic hopes. All the signs show me that the housing market crash has started. The Home Purchase Sentiment Index, HPSI for example, is an important index that we need to focus on. Please look at the chart. The HPSI shows consumers' opinion of whether or not now is a good time to buy or sell a home. And the most recent data highlights what I'm saying. The chart shows an almost 10-year period in which consumer views consistently rose, becoming more and more positive until the first months of 2020. Then, starting from February 2020, there was a massive plunge. In April 2020, the index fell to 63%, which is the lowest percentage in 9 years. As consumer housing market expectations worsen and the current crisis continues, this index will continue to drop. This chart is another one that shows significant data. It's about people's perceptions of job security over the next 12 months and shows an overlay of 3 different lines. The percentage of respondents who are concerned, not concerned, and a net figure for not concerned, which is calculated as the not concerned minus the concerned respondent rate. In the chart, the ratio of people concerned about losing their jobs doubled between February and May 2020, which is important. By June 2020, more than 26% of respondents felt concerned about losing their jobs. The number of those not concerned dropped from 88% a couple of years ago to 74% in June 2020. You can easily see this by following the net not concerned line as it edges closer and closer to the concerned line. As people become more concerned about their livelihood, it raises household concerns about being able to make rent or mortgage payments as well. Job loss has always been a significant reason that mortgage loans don't get paid. Understanding how mortgages work is key to recognizing potential housing market crashes and the future prospects of the sector. While mortgage seems like regular credit or a standard loan, there are some crucial differences. When it comes to millions of people using the same kind of credit, a mortgage bubble becomes a fundamental part of any economic crisis, whether national or global. Individuals get a mortgage to purchase a home or apartment and make a loan payment each month, which is a normal circumstance. This is the part we see and are familiar with. However, behind closed doors, these lending institutions use financial engineering tools to bundle together mortgages, bonds, and other types of debt they're owed and have security or collateral for as collateralized debt obligations, or CDOs. These CDOs are then sliced up and sold to third parties around the world. You may remember that this played a significant role in the global financial crisis of 2008. But before getting into these kinds of financial details, we should look at some additional data and recent news. According to Anna Bani from CNN Business, 4.3 million homeowners missed their mortgage payments last month. This means 4.3 million people failed to make their monthly loan payment to their bank. This is the highest number since 2011. CNN gathered this data from Black Knight, a mortgage data company. According to the same article, delinquencies have increased more than 50%, with hundreds of thousands of people more than 90 days past due with their payments, which is a huge rise. These stats are totally correlated with mass unemployment and global financial collapse, which I've been explaining as much as I can in my videos. But people would prefer to believe in a rising stock market and a Federal Reserve printing money into a system that creates today's illusions. As I've stated in my last few videos, financial markets are just a reflection of the real economy. If individuals lose their jobs and cannot pay their mortgages, it affects the entire economic environment. In addition, CNBC has significant data regarding mortgage forbearances. According to an article published on CNBC, the number of forbearances represents $890 billion, which includes 6.4% of all Fannie Mae and Freddie Mac backed loans and 11% of all FHA/VA loans. There's a reason why I mentioned Fannie Mae and Freddie Mac. These giant housing finance companies played a vital role before the 2008 financial crisis as well. Just as today, the 2008 global financial crisis all started with a housing bubble before 2007. Before the crisis spread throughout the world, it was first a mortgage bubble in the United States. Subprime mortgages, in particular, played a vital role as they made up a significant part of CDOs. Nouriel Roubini, also known as Dr. Doom, warned the markets in 2004 and 2005 that the mortgage market was a complete bubble. Nobody listened to him. And in the end, everybody experienced the global financial crisis. Several things were then questioned, one of which was globalization. Another issue that led to a lot of discussion was the use of financial engineering tools such as CDOs. There was also a lot of debate around regulation versus deregulation. Additionally, people in the U.S. lost confidence in reputable companies such as Moody's, Fitch, AIG, Bear Stearns, Citibank, and so on. But globalization stood strong against deglobalization movements. Now, however, we are seeing the collapse of globalization. The Great Recession of 2008 was a global financial crisis which occurred due to the use of financial tools like derivatives. In other words, mortgages make it so that individuals can afford to buy housing, but the use of financial instruments turns mortgages into securities that can be bought and sold by other companies around the world. Two things are important regarding the 2008 global financial crisis. The first is that it was a truly global crisis. The second is that it was a financial crisis. Today's crisis is very different than the Great Recession. While today's crisis is also global, globalization itself is the problem at this moment. Second, the world is more financialized. This is not just a discussion occurring today. Just 1 year ago, on June 28, 2019, Michael O'Sullivan, author of The Leveling, was interviewed by The Economist. One of the questions asked by The Economist was, what killed globalization? Michael O'Sullivan replied that at least two things have put paid to globalization. First, global economic growth has slowed, and as a result, the growth has become more financialized. Debt has increased, and there's been more monetary activism. That is, central banks pumping money into the economy by buying assets such as bonds and, in some cases, even equities to sustain international expansion. Second, the side effects, or rather the perceived side effects of globalization, are more apparent. Wealth inequality, the dominance of multinationals, and the dispersion of global supply chains, which have all become hot political issues. The Financial Argument channel also made a video with respect to rising inequality and the billionaires that have made billions more during this crisis 2 weeks ago. You should definitely watch that as well. Anyway, the impending end of globalization is clear. Of course, this doesn't mean that we're all going to have to live in caves. A new global order will soon be established. In other words, we are experiencing the New World Disorder, as The Economist specified in its weekly headline on June 20th, 2020. All in all, the housing market is the dominant market leading the real sector and financial investment sector. Therefore, understanding mortgages and mortgage-backed securities provides significant insight regarding the near future. As I previously said, more than 4 million people cannot pay their mortgages at the moment, which is the highest level since 2011. And according to Oxford Economics, this number will increase. This means that millions of people may default on their loans, causing banks and financial investors to struggle as well. Global banks such as Barclays, HSBC, UniCredit, Deutsche Bank, and more have all increased their provisions for this eventuality. No one knows exactly what's going to happen in the near future, but it's obvious that the financial system is changing. It won't ever again be the way it was in 2019. Subscribe to our channel to get more news regarding the current crisis. Thanks for watching.